All right. Hi, everyone. Thanks for joining us this evening for our panel session with a focus on climate risk and the policy and thinking shifts needed to make a difference. Before we start, I'd like to acknowledge the traditional custodians of our land, elders past and present, and the inherent wisdom, the inherent resilience of wisdom continuously passed down through them, acknowledging also that we are coming from many different areas today, many different lands. A reminder that this session is recorded and will be shared later for those who are unable to make it. Thanks very much for joining us on a 5:30 in the evening as well. I note that there's a few cameras off, no problem. Everyone will be listening in as we work this through. So thank you very much. The Resilience Canopy is a not-for-profit movement helping communities across Australia become stronger and more challenge-ready, adaptable to climate disruptions and social stresses. The Canopy Collective, and you're here today, connects Canopy-trained practitioners and communities with others working in resilience around topics of interest. Through the collective, we hold a series of check-ins for those involved in the Canopy program, as well as masterclasses and keynotes. And I'd like to say a warm welcome also to some of our practitioners and some of the communities that we're working with. Thank you for being online. On today's session, firstly, a slight change in our panel membership. Melinda Morris is unable to make today, but her very able colleague, Genevieve Morris, Genevieve has stepped in with thanks to Jen, and a nod to Duncan Sheppard, who is a little bit unwell and valiantly trying not to cough as we work this through. Genevieve Mortimer is a principal at Climate-KIC Australia, focused on driving systemic investment for climate resilience and distributed energy innovation. She currently leads the Collaborative Energy Transitions Initiative, which fosters trust-based partnerships to accelerate investment in renewable energy and resilient infrastructure. Genevieve is deeply committed to enabling systemic change and brings a strong understanding of the importance of place-based solutions in achieving climate resilience. We also have Duncan Sheppard from the Insurance Council of Australia. As the ICA's Senior Resilience Advisor, Duncan drives the ICA's advocacy agenda for improved resilience in the built environment, with a focus on improving Australia's building codes and standards, investing in household and large-scale resilience measures, and improved land use planning arrangements, ultimately helping to maintain an insurable Australia. The topic today with our two panelists is the shift in thinking and policy needed to better manage a future that will challenge organisations, government and communities. No single organisation or individual can change systems and solve climate challenges alone. And Duncan and Jen will talk us through how systemic change can be designed and supported through policy, innovation, practical solutions and collaboration. Now, our format today will have each of our speakers presenting for a short while, then some facilitated questions. We'll have the opportunity for questions from attendees also as normal, so make sure you pop them into the chat as you think about them. And with thanks to Jen as our first presenter, over to you.
Great. Thanks, Natalie. And yeah, really happy to have the opportunity to step in when Mel couldn't make it, because yeah, we keep at Climate-KIC Australia, we keep a good eye on things that are happening at Resilience Canopy and love the sort of work and also the shift in thinking that that organisation has helped create. So thank you for having us on. Now I'll share my slides from my end. Hopefully this will work, and then
yeah, beautiful. And Jen is actually in our office for those as part of her stepping in for us, which is a lovely thing. Thanks, Jen.
No worries. Go back to the first one. Now, before I jump into the slides, I wanted to actually share today, thinking of the topic shifting in our thinking, my own sort of shift in thinking that happened in regards to resilience, and particularly resilience investment. So my shift started about 8 years ago when I actually first joined Climate-KIC Australia. I was leading the climate adaptation finance project, and before then, I didn't really have a background in adaptation or resilience specifically, but had done a lot of sustainability and climate change in different facets. Now, what was interesting about this project is it was set up for success. We had the right people in the room. We had the right, we were all aligned on the goal. So, the stakeholders that we brought together were insurance, they were from the banking sector, they were from state government, we had investors, local government, and they were all aligned on this idea that there's a resilience or adaptation, as we called it then, investment gap. And how do we work together to channel public and private investment into this adaptation problem? We were also running the project at a time where there's it was gaining some global coherence on that being a big need. So at that time we had Davos, I think it was 2018, 2019 conference, where climate change and resilience related impacts were really making up 7 of the top 10 of the threats to the global economy. So it was like everyone agreed we need investment to increase resilience and adaptation. And the shift for me came when this didn't work, when we were there as this project and we actually couldn't get past these sort of bigger thresholds or something bigger that were going in circles around how do we get this channel public and private investment into this adaptation problem. And what we found was there's not really any investment-ready projects, and this hotly desired pipeline of resilience investment projects that are orientated to public and private finance didn't exist. And that role of private finance and private capital really did still remain unclear. So it's interesting, despite all the right people and the right intentions, we got stuck. And that was my shift. That's forced a deeper dive. That's process digging deeper into what is what are some of the core things that are going on here, some of the bigger boundaries, the bigger barriers, sorry. And then as part of that, I was reaching out to people like Russ Wise and the CSIRO team, and they'd had recently released the Profiling Australia's Vulnerability Report, which I still think is a really excellent report that puts down the nature of this complex and systemic nature of the problem that we have around adaptation. I'd also reached out to my Climate-KIC colleagues in Europe, and then one person there, Dominic Hofstetter, was setting up the Transformational Capital Initiative, which is understanding what is this link between systems thinking and investment logic, and how can we drill deeper into what are those fundamental problems with the investment ecosystem and unlock some of these systemic changes, of which I saw adaptation and resilience as one of them. So through these conversations and many others, for me, it was clear that we were stalling because there was an underlying logic issue with understanding what it meant to have systemic approaches to adaptation. It sort of threw me into my first, ringing in my ears was when I was in an undergraduate in environmental engineering. My lecturer said that, the most dangerous thing we do is treat human and natural systems like machines. And for me, I was like, okay, resilient, it threw me right back to that, where resilience is this complex problem. It's actually not a machine to be optimized. It emerges from interconnected, ongoing, multi-layered interventions. It's non-linear, they're context-specific, and their value is often distributed amongst multiple stakeholders. It happens with community empowerment and increasing agency, all these things that aren't factored in to often not factored into a single asset investment logic. In short, systemic problems demand systemic solutions, and that's no difference from when we're looking at a financing and other approaches to resilience. So that was a long-winded intro, but I wanted to give you a bit of context about where since then I've been working as a core feature as Mel and Climate-KIC more broadly of how do you do the systems change part? What is those capabilities that we need, and where can we help? So in today's presentation, I'll dig a bit deeper into the problem, again, understand the problems and taking the cues in this case from the National Climate Risk Assessment. So this is it. And then I'll say a bit more about what I started with, which is looking at these contrasting approaches. So what is the difference at some levels between incremental and systemic approaches to resilience? Then I want to dive quickly into seeing what's and focusing on this idea of collaboration, because I think it's a core feature of what we're talking about today. And why this idea of collaboration, how do we move beyond it as a nice to have, but actually see it as a critical asset, maybe even an asset class in systems change and resilience? And how this is collaboration is, I guess, the not so secret sauce. And I think everyone on the call would sees that. And then I'll briefly end with just pointing to some of our work in systemic resilience in the places that we're working at KIC. So the climate risk assessment was released a few weeks ago, and certainly there's probably no surprises, but it did paint the picture of some of the risks that we're going to expose to. So we've got extreme weather like bushfires, heat waves, flood. Heat days will increase. Linking that to the loss of productivity and putting some numbers around that, the extent of the loss of productivity that disaster spending we didn't have resilient strategies, that it's 7 times higher by 2090. And that this is also a supply chain, that looking at the supply chain and the disruptions across the supply chains, uninsurability. It's an extensive report, and it touches on all facets of Australian economy and society. And that includes biodiversity. So what is interesting from a systemic perspective is what it clearly shows is climate risks will cascade across systems, and there's implications across public health, economic stability, national security, across these broad facets. And it also points to the systemic and coordinated nature of both the challenge, but the response that's needed. So this is not new to us at KIC, and I'm sure it's not new to people on this call. And then we've been working in different facets of this resilience or adaptation challenge since our inception of KIC, which was about 8 years ago as well, about 10 years, a bit before I started. And that includes the Adaptation Finance Project, which I mentioned. It includes the Resilient and Futures Investment Roundtable, which Mel Morris convened. It includes some partnerships with CSIRO, the Enabling Resilience Investment team there, including looking at Cabargo and what energy transition options after disaster recovery. And it includes an ongoing work in how we partner and collaborate around this idea of systems approaches to resilience, but particularly systemic investing. Now, I'm conscious, let me just see. Oh yeah, I've got a bit of time, I think, still. So I use this diagram a lot. This is a classic Climate-KIC diagram, and I like it because sometimes the way to understand what systemic is to contrast it with what's not systemic. And so what we're talking about, this is from a very broad view. I mentioned words like single asset logic, and that's sort of from an investment lens. But part of it is shifting from that single asset logic to a portfolio of connected projects. Sometimes that's also looking at recognizing that value and resilience doesn't happen at a bounded single asset, whether it's household level, it happens across landscapes. It's how different technologies will work together. It's those interconnections between them. So we often talk about this portfolio of connected initiatives that learn from each other. When we're talking about the approaches, it's a shift from often commercialization of an individual technology or project, which you actually see a lot of grants, a lot of funding is still working in how do we commercialize individual projects, versus a systemic approach would be how do we create the enabling environments by investing in people services that enhance capacity, building trust, growth and knowledge. And I'm sure you can see in that line why I am so interested in the work Resilience Canopy does. And then there's this other things around short-term thinking with a focus on risk management versus the thinking that's guided by a long-term vision, and that's actually is wanted by communities. So I won't have time to dig too much into it, but basically what we tried to do with Mel and the Resilient Futures Investment Roundtable is get a bit more concrete about what it then meant to apply processes that looked at looking at the problem from a single asset lens versus looking at the problem from a systemic lens. And this was developed, we really leveraged some of the work that CSIRO led, CSIRO, and the Enabling Resilience Investment Platform with Value Advisory Partners led in this work in Cabargo, developed in the APCD framework and trying to make it more generic so that we could use it as a tool to look at, as I said, increasing resilience. So here, if we look at it from the single asset lens, what we'll often talk about is valuing avoided losses, even in some ways co-benefits of a specific piece of infrastructure. When we work into those C&D frames, we move beyond that to actually explore the interconnected things across the system. And we ask questions like, okay, how do we coordinate across sectors to build adaptive capacity? And it's from C&D that it like all of these need collaboration on some level, but it's C&D where you recognize that collaboration is actually, and those connective tissues that you're trying to create is actually the source of value in which other things can then sit upon. And then D, we are looking at how do you also factor in these emergence, this idea of emergence in your strategy and in your investment logic. And so some of those questions then shift to, okay, well, what does it mean to actually in Australia, and maybe a big picture level down to the small picture, how do we shape resilience and markets that actually unlock resilience? What happens when we start allowing communities and people to ask the what if question? What if we achieve this goal? You know, what if we create this distributed energy system where people can access in different ways? Or what if we actually improve the quality of our housing? And so who's attracted then to this region? What other things can we do? And so that's that sort of emergence and the value of that. How do we factor that into some of our thinking and strategies? So in that, I mean, before I just jump to that, you'll see in the middle of this circle is a whole bunch of dots. And so, and connectivity, which is, you know, again, something we talk about a lot at Climate-KIC. We use that sort of idea and whether it's metaphor or things come up a lot. And I think one thing that it shows is moving to that collaboration is critical. And so for me, it's interesting to say, how do we move beyond this as a truism to actually look at it as a critical asset? And how does that then help us in terms of doing this work? So I guess the adaptation plan, I feel like there's not a day where we don't have a new plan or a new energy transition thing that actually says at the end of it, we've got like collaboration or something like that is the key ingredient here. So the National Adaptation Plan also identifies that collaborative, place-based and inclusive as one of its core principles. So this is what sits next to the risk assessment. So that is great. And it's really actually great to see that now totally understood and embedded across these plans. I've seen other ones around energy transition and how trust is the key thing. But I think for me, it's also like, okay, when we're moving to the how, what does that then mean? And how are we developing the approaches and the support and the capacity that's actually needed? And on the other side, investing appropriately in that as an asset so that we can get some of these resilient outcomes that we're seeking. So in this end, CSIRO are leading some work on social architecture, and in the recent telecommunications resilience investment project that we're collaborating with them on. We were co-leading this work on social architecture that looks at that intentionally, the design of the methods that we use and the governance and the processes that actually allow people to work together better on complex challenges. And some of the work I'm doing in the energy sector, it's the same. I'm really focused on what is that collaborative model? Who do you bring in and how? That actually looks at how do you unlock the value of all this potential distributed energy assets. And there's a whole bunch of other projects from our end that KIC is often centered or around a complex kind of collaboration. So but I'm ending there, and this is just really pointing to some of the projects and partnerships and areas that we are looking to work in or actively, forming kind of project and portfolio areas. And part of that is these collaborations that kind of also see the same nature of the problem. And for example, with Dark Matter Lab Capital, they're looking at what are these many-to-many financing infrastructure. And as I mentioned, Transformational Capital Initiative, it's what is that financial backbone and what is their role in this process in bringing people together. So that's what we're trying to connect the dots with some of these things and also connect it down to that community level. So I'll stop sharing at that point.
Thanks very much, Jen. I think you've given us a high-level outline around the, policy positioning, kind of the enables and governance for collaboration, and as examples in the energy transition kind of sector. And I think we'll ask Duncan to pull up his slides in a moment to actually start providing a bit of an example also about how it's being done in the insurance sector. We will come back in the facilitated questions with a couple of examples about how that actually starts to be to trickle down, I say, but in an important space in the more community space, and actually talk to the impacts that we want this top level to be able to support and enable as well. So thank you for that. And Duncan, if I can hand over to you.
Thanks very much, Natalie, and thank you, Genevieve. Great presentation. And hi, everyone. Duncan Sheppard. I'm from the Insurance Council of Australia. My role here is the Senior Advisor for Resilience, and it's a pleasure to be part of your Resilience Canopy Resilience webinar series. Today, what I'd like to do is speak a bit about the measures that we're taking as an industry to close Australia's extreme weather protection gap from an insurance perspective. But before I begin, just a bit about our industry. Our members obviously provide products such as home and contents insurance, motor vehicle insurance, and also a range of business insurances such as public liability, professional indemnity. There's about 86 million policies around Australia. 12 million of these are for homes, and that's what I'll focus on today from a resilience perspective. We have a saying at the ICA, a resilient Australia is an insurable Australia. So we've got a really strong focus on research and advocacy to support positive policy change. And what I'd like to do today is share with you some of our advocacy agenda priorities. As Genevieve really well outlined, the National Adaptation Plan and the Climate Risk Assessment has provided us with the tasks in front of us. We are experiencing and will continue to experience extreme and more frequent weather events, and a changing climate brings with it new risks and new costs from an insurance perspective. And nowhere is that more evident than here in Australia. There's about 5 key drivers impacting on the price of premiums here in Australia. You would be familiar with a number of these. The first is obviously the escalating cost of extreme weather. We've done some modelling released this week, which found that the cost of extreme weather just over the past 12 months reached about $2 billion. And that was driven by 3 significant events: the North Queensland floods, which are about 300 million, ex-tropical cyclone Alfred, about 1.5 billion, and the mid-North Coast and Hunter floods, 250 million. The second reason is the growing value of our assets and inflation, and that's particularly in the building and motor repair section. Since COVID, it cost about 30 to 40% more to build a house than it did pre-COVID because of inflationary pressures. When you add to this a shortage of labour, that considerably increases insurers' costs. Compounding that is insurers' costs doing business with rising reinsurance. Reinsurance is the insurance that domestic insurers take out on the international market, and that's to protect them from losses. So as there are more losses globally and more extreme weather events, reinsurance costs rise. So take, for example, the fires in LA, that has a ripple effect across the entire industry. The fourth driver is an expansion of development in those high-risk zones. We know that people in Australia love living in the bush, they love living near water, but with those considerations, there is added risk that we had to take into account. And when you put all those 5 drivers together, that is placing considerable pressure and cost on the insurance industry. So as I mentioned earlier, we've released a report this week called the CAT report. It's got a lot of media. It could be on the 7:30 report potentially tonight or tomorrow night. So keep an eye out for it. What we did as part of the CAT report, we compared our annual average cost per person against comparable countries: France, Canada, Germany, New Zealand, and the United States. It has found that over the last 45 years, Australia has ranked second only behind the United States for economic and insured losses per capita. So each decade from the 1980s, losses from floods, from fires, from storms, and from extreme cold temperatures have climbed across the globe. Our persistent second placing reflects obviously our unique geography, but it also reflects our exposure to natural perils. And this is compounded by a growth of residents in high-risk areas, and the fact that our infrastructure that really has not been built to withstand the impacts of climate change. So with more frequent and more intense disasters, coupled with that development in high hazard areas and climbing asset values, it's widening the gap between those who can access insurance and those who cannot. And this is leaving a growing number in our community unable to rebuild and unable to recover when disaster strikes. And we call this the insurance protection gap. To illustrate and to put some more numbers on the table, Swiss Re estimates the protection gap from natural disasters in Australia is around 33%. So they estimate that in Australia, total economic losses 2 years ago was about $37 billion, and insured losses were $24 billion. And that leaves a protection gap of around $12 billion. So in practice, what this means, it leaves businesses and communities without a safety net. It erodes the ability of Australians to bounce back from fires, to bounce back from floods, and also cyclones in the way that they could and should be able to if they had insurance. And obviously, this is not a problem or a challenge confined to Australia. There's predictions that the protection gap worldwide is about $1.8 trillion. So the most concerning and the costliest aspect when we look at the scale of these events, it's from flooding. And the impact is also obviously economic, but it's the social cost that is borne by those people in those high-risk areas. We know that there's a clear correlation between high flood risk and socioeconomic disadvantage. We know that our most vulnerable are those who can least afford insurance safety net when that disaster strikes. High-risk land can often be cheaper and has often got lower property values. And as a result, we do know that there's a high concentration of residents in lower income households living in these high-risk locations, and they have a limited ability to relocate or to invest in household mitigation to drive down that level of risk. In broad terms across the nation, and it's predominantly down the East Coast, we estimate there's about 242,000 homes with the highest flood risk in Australia. And we think about 186,000 of those are not insured for flood. 70% of them do not have flood cover, and about 70% are in areas where the average income is less than the national median. So the cost of the premium and the limited means of homeowners can often result in residents being underinsured. For example, they may have opted out of flood cover to make their insurance premium more affordable, or they may not have insurance at all. And this leaves those residents who need it most in the need of support without a vital safety net when those extreme weather hits. And as Genevieve explained, they're becoming more extreme, they're becoming more frequent, and they're moving to areas we haven't experienced them before. So thinking more macro, the erosion of insurance in our riskiest locations has long-term impacts for the economy. An initial assessment by the industry has found that in the first 6 months of 2025, the cost of natural disasters is estimated to have cost our economy more than $2 billion. And that will obviously increase as we get towards the end of 2025. So there are the issues, there are the challenges. Let's just talk about some of the solutions we're putting on the table for government and industry to discuss. We continue to advocate for solutions that reduce the level of risk and to maintain downward pressure on premiums. So we work with governments to deliver solutions in a number of ways. This includes land use planning, stricter building codes, and investment in resilience measures. We encourage a broad conversation between all levels of government and industry, with the insurance industry, about whether houses are really safe to build, and if they are, how do we rebuild them to withstand future events? And our policy approach is based on addressing two key questions. Firstly, how do we improve the resilience of our existing homes? And how do we improve the resilience of our future homes and buildings and commercial facilities as well? So to achieve these objectives, our approach is built on these three pillars: increased investment in infrastructure, a more risk-based approach to land use planning, and strengthening the National Construction Code. So I'll just go through a few of the highlights from these policy recommendations at a really high level. So extreme weather events in the last few years have highlighted there's a need for policy settings that better consider the relationship between land use planning and extreme weather risk. And we think there needs to be more of a risk-based approach to land use planning to protect lives and properties. So in practice, that means any housing development in areas prone to extreme cyclone, bushfire, and flood risk should not be permitted. And those with moderate to high levels of risk, they need to be accompanied by stronger building codes and standards and resilience infrastructure as well. Planning must consider both the likelihood and the consequence of the full range of possible events, including, as the climate risk assessment has showed us, larger and more frequent events. So in terms of our concrete policy proposals to government, we've proposed the establishment of a fairly radical idea called the National Flood Defence Fund. This is a $30 billion fund over a 10-year period, which is shared between the Commonwealth governments and Queensland, New South Wales, and Victoria. The aim of this fund would be to reduce the impact of future floods, moderating insurance premiums in high-risk areas, and minimising the impact of post-flood recovery and rehabilitation. Because we know over a number of years, the amount that has been spent by governments on post-event recovery and rehabilitation has dwarfed the amount that has been spent on resilience mitigation to lower the level of risk. So the Flood Defence Fund is built upon an analysis of what are our highest flood risk locations across the East Coast, and there's about 24 of them that have highest flood risk of extreme and severe flood risk. And across those 24 catchments, we have proposed 4 key measures: new flood infrastructure, such as levers and floodways, to reduce the level of risk; a range of measures to strengthen properties in harm's way. And by strengthening properties, we're talking about measures such as increasing the height of the home or putting those essential services above the expected flood lines. The third component is managed buybacks, relocation, and working with communities before disaster strikes to identify ways in which we can safely and appropriately relocate communities out of harm's way. And a number of state-based flood resilience programs have really taken some great strides, particularly New South Wales, to relocate communities. The other measure that I just want to touch on before I close is embedding resilience in the National Construction Code. And this would be a key measure to ensure that new houses built can better withstand the impact of extreme weather events. Presently, the National Construction Code appropriately recognises such things as accessibility, environmental standards and safety. But unfortunately, the concept and the principle of resilience isn't really embedded in the National Construction Code. So we think it's an important step to not only ensure that we're building in the right place, but the homes that we're building are fit for purpose for 100 years lifespan. And we think that failure to do this is probably costing our economy about $4 billion a year from those various perils we've discussed. So that probably wraps it up from me. I suppose just to conclude, the ICA really is keen to look at policy proposals that addresses the issue of more costly extreme weather events, looks at ways in which we can boost resilience investment, particularly for those Australians who are facing increased risk. We're very concerned about the accelerated losses per person when it comes to insurability, the availability of that insurance and the affordability of that insurance. And that problem is obviously going to compound unless measures are implemented by both government and industry. And with the cost of rebuilding increasing, we really do look forward to working with all levels of government to invest in strategic resilience to help close Australia's extreme weather protection gap. Thanks, Natalie.
Thanks very much, Duncan. And I think I would say that discussions around insurance can be a bit vexed because they are often connected to events where community members have very personal experiences and, sometimes traumatic, of course, in that way. So thank you for providing, that outline. And I did note that report was the catastrophe report, which is quite an emotive name, was released, I think, yesterday by the ICA. As we go into some facilitated questions, and there are a couple in the chat coming up, I'll ask you to have a look at. I guess just to note that there are some things, Duncan, that you can talk to and answer through your experience and the role of ICA, and not everything will be able to be answered because there will be some specific, some things that are specific to specific insurers. So, but just in that way, you started to talk through this. I'm going to stay with you for one moment and then go to Jen. But can we pull a little bit more then at the threads of what's the role of the insurance sector in mitigating and supporting communities through the risks and the impacts, and if there are any gaps in how the sector sees its role at the moment?
Yeah, sure. There are always going to be areas where industry can and should improve. So you'll recall the significant floods in far north New South Wales a couple of years ago, where there was significant losses. And as a result of that, there was a parliamentary inquiry into the role of the insurance industry and how we are meeting the needs of customers, and more importantly, how we're not meeting the needs of customers. And so over the last 18 months, industry has rolled out a number of measures to better communicate with customers. And a good example would be take Tropical Cyclone Alfred. In the lead up to Tropical Cyclone Alfred, industry was proactive in talking to on the ground policyholders. I think we made about 250,000 calls in the 48 hours before Tropical Cyclone Alfred was to make landfall, to talk about ways in which people need to better prepare themselves, but also to talk about those potential insurance issues which you're probably less able to have a conversation with in the during or the immediate aftermath. So there's some really clear lessons for us from a communication perspective. That's the insurers doing that piece of work. But in terms of what the ICA does, whenever there's a declared catastrophe, the Insurance Council sets up a immediate presence on the ground. So, the Tari floods 6 or so months ago, within 24 hours, it's declared a catastrophe. We go on the ground and we bring all the insurers together so people can have face-to-face conversations with us, because we know that in the immediate aftermath, it is really difficult and challenging for people to have a lot of these conversations on the phone. And so there's sort of the ways in which we're addressing how to better respond to those risks from a customer perspective. Obviously, we've got a big advocacy agenda to encourage government to invest more. But at the same time, we're really keen to work with our members to say, okay, well, these are the issues that people are facing. How can we better communicate them in a timely fashion and being sympathetic to their needs? Because one of the big lessons that we learned from the 2022 floods is that there were some major challenges, and I think we've made some progress to address a few of those.
Thank you. Thanks, Duncan. I'm going to, there's a few questions, of course, around insurance, and I want to just pause and come across to Jen, because the insurance sector is a big and very visible one, of course, and has been called out for, needing to work in a different way. So, and it is an example of a sector that is collaborating and does have, an advocacy agenda. Jen, just from your perspective, in this climate and energy transition space, maybe what's the role of business as an industry in your view, and have you seen gaps in mitigating and supporting communities through the risks and impacts? Sorry, just to finish that question.
Yeah, I think there's multiple ways that I could answer this question. I mean, one thing that stuck out, I mean, there's plenty. That was a really interesting presentation, Duncan. Thanks for that sort of overall picture. And I think there was this stat right up the beginning where you said, we were talking about Australia being second place in kind of insurance losses. And then we start talking about those big numbers of what it costs, and it comes back to this thing that we kind of know, but that value of the resilience and the hit they take to productivity and how that impacts all businesses is big. And so I think from the experiences, like, as you know, even going back to that original project, but the projects we're working in, okay, well, what is the role of businesses? It's multifaceted. And what is even the role of insurance and the investment ecosystem? I think there's some, when I was thinking about that original project where we had bankers insurance, I think there is something in understanding, okay, we know all this, the size of the both the challenge as well. You could flip it to the opportunity if we start actually becoming a much more adapted, a resilient nation. But we also know that requires businesses to work together differently. I mean, just very practically in the energy system stuff I'm doing, we're talking with a port, and they have a whole bunch of tenants, and so you have to, and then the way that they're engaging in putting resilient measures in, putting rooftop solar on is different. So they have to engage in this whole process and bring them together around that. It's also the relationships now between these bigger businesses and the utility, the distribution network is different. There needs to be more understanding of what energy is flowing and how that works, and capacity to manage that locally. So there's actually, I guess there's a lot of different roles of businesses, and I think there's something in understanding, yes, we're all getting more aligned on how valuable this is, and then really understanding, okay, beyond after, insurance claims and what happens after, what does it actually look like to get prepared and to invest across it, and what is then, the different roles that they play. And I mean, it comes, there's a lot of different ways, like where water utilities become energy generators, become other things, like that's their role is shifting, so there's there is a lot of stuff that happens at the intersection between things, and that's again some of the focus on collaboration.
Jen, can I stick with you for just a moment and just ask, where does community figure into the work that you do or support? And then we'll go to Duncan, also with the same question.
Yeah. So I think that this, that tourism that was in the National Adaptation Plan, that collaboration and place-based projects are essential. So, what I look for is in any of when we're looking at like investment architecture, okay, it is actually what starts with that place-based situation that's happening, and then understanding, okay, what can you put above it that then helps scale that. But it doesn't happen, you're doing it in that place, because this is where like places and communities are where you feel the stresses and where you understand where solutions are integrated, like real solutions. So I guess what I'm trying to do in my work is just shine a light on how critical that is, and then also what that then means from an investment perspective, like how you actually then get the right amount of investment, because I guess we all know these things of like not having enough money to do that collaborative work that is needed then to be able to then start to do some of the preparedness work that we're talking about here, that then can lead to insurance premiums, insurability, and all these sorts of things. There's a tail. So I'm kind of really want to make sure that that's not missed, that tail, and therefore then if we're building investment logic, that's front and center, that communities, again, not something that's, oh yeah, you just say it at the end of the report, but it's like a fundamental thing of where value is created around resilience.
And are the right things being supported? Okay. Thank you. Thanks very much. Duncan, if I can come back to you around the same question, where does community go into the work that you do?
Yeah, fundamental. And a good example would be the work that is undertaken by the Resilient Building Council. And I'd note on the call, we've got Laura Durango from the Resilient Building Council on the line. And that's a really good example of how you bring members of the community along on the journey to assist them better understand the practical and the measurable actions they can take at the home level to increase their level of resilience. So the Resilient Building Council has developed a really important tool to assist people better understand their level of risk to bushfire. It's a simple and easy to use and effective app. And that enables people to not only undertake those pieces of work, but obviously to get that level of certification. And that's an important measure from the insurance industry's perspective, because that then allows our insurers to make judgments on the extent to which measures undertaken at the home level can and should feed into pricing. Because when people and governments at the same time, when they invest in resilience measures, they want that level of comfort and knowledge that the measures that they undertake are going to be recognised by insurers. So a couple of insurers have signed up to the Resilient Building Council's bushfire rating app, and the Resilient Building Council is working to broaden that out to a multi-peril tool. But fundamentally, it's at the heart of it. It's about empowering communities to undertake works to their properties, and then working with insurers to recognise that as part of the pricing regime.
Julianne from VCOS actually has it's quite a nice segue in this, and she's actually asking that what's the ICA's position around supporting households that can't invest in strengthening their own resilience. Example, many will need full investment in retrofit and relocation. Does the ICA have a position, an advocacy position around these?
Look, it's a difficult one, because we're obviously aware of the fact that not all people can undertake those resilience measures at the household level. And that really then reinforces why governments need to play a lead role in investing in that community infrastructure and the community resilience. So as I mentioned earlier in my presentation, we're of the view that there should not be any further development in those high-risk zones. When there is development in those moderate zones, there needs to be infrastructure funded at the state, local, and federal level to reduce that level of risk, because we know that not all people have the capacity to invest in their home's resilience. So it really does underscore why there needs to be a shared approach by governments to also provide those targeted resilience measures to reduce risk. And this really goes to one of the key issues that we're very keen to highlight as part of this risk conversation, is having a really good sense of where the investment is most needed. And that really relies on really in-depth flood modelling and data. And so we can target those high-risk areas, and then working with your communities to really understand the risk that homeowners face. And so we really do advocate for councils to work closely with their communities to bring them along the journey. And importantly, for that data, their flood modelling data, to be fed into the insurance industry so we can use it as well. So if there have been improvements to resilience infrastructure, that can be reflected in premiums, because that's a really important point as well.
Some of the measures that you, or the advocacy that you outlined, are quite, will feel quite stark for some of the community members and others on the call when we talk about potentially having to move towns or relocate people, and when you have flood mapping, and I think some more mapping just got released just recently as well. Maddie, if I understand your question, I'm working backwards through my chat. What are the implications for those who already live in these areas? Were you referring, Maddie, if I may ask, if you're still on the call, to some of the flooding, some of the mapping that is already being done, and those questions?
I was. Thanks, Nat. Yeah, just briefly, I think it was around that point around planning for new developments in high-risk areas. And I feel it's somewhat been addressed there. And I think, Nat, for me personally, in sitting through this, I have a whole wave of emotions. Some of them are philosophical and others are very logical and data-driven. And for context, I live in Shepparton, which is a fairly well-known area in terms of being at a high risk. And there's a lot of ongoing discussion and debate, I suppose, around what a climate resilient future looks for our region. So I'm very interested to hear some of your words, Duncan, around the ICA's perspective on this. Thank you.
When it comes to matters such as relocation, obviously having conversations with communities at the appropriate time is paramount, because I think one thing that we know is that in the aftermath of an extreme weather event, particularly, let's include them all, bushfire, flood and cyclone, the stress and the mental anguish and the social dislocation associated with an event, it is the last time you want to be talking to governments about relocating. It has to be done well in advance, and it has to be done in an appropriate and considered fashion. But they are hard conversations, but I think they still need to be held. And so, as I've mentioned earlier, it needs to be driven by the data in terms of what are the highest risk locations, and where is it most appropriate for government to be spending taxpayers' money to potentially relocate people out of those really high risk zones. So it's one of the reasons why we think there should be a more publicly available national climate hazard database. So we're all effectively on the same page. There is greater consistency and transparency in terms of the hazards that we're facing and the risks that will impact us in the future. And the National Adaptation Plan and the Climate Risk Assessment sort of pointed towards the need for work in this space, but we think there's still work that needs to be done to get that level of consistent data. And so people are making informed choices about where they're going to be living in the future, and taking into account the risks from an insurance affordability perspective as well.
I just want to acknowledge, as we come to a close, we've got a couple of other questions. Gary and Kyla, just acknowledging your questions. I do want to just take Jennifer's, which is indicating that the NCC already includes differing standards for various zones of rain and wind. This could be further augmented across other criteria, and increasing the quality of building will also significantly increase the cost of housing. Cost of living in a housing crisis. How could this be accommodated? Jennifer is asking.
Look, that's a really good point. And obviously we're living in a housing crisis where the cost of housing is is a significant factor in people's budgets. But what we would argue is the most expensive home to build is a home you need to build twice or possibly 3 times. And so, yes, there would be potential cost impacts, but over the life of a building, we think there are significant cost savings. If you are embedding resilience in a build, particularly in a high-risk zone, you're significantly reducing the potential for there to be damage in the future, and obviously reducing the potential for there to be a complete rebuild. That's where there's going to be significant costs over the life of a building. Having a longer-term approach to what sort of building stock do we need, not just for 2025, but for 20, 30, 40, 50 years in the future.
There's an awful lot in this, I know. I want to start to come to a close with a question, just coming back to Jen for the moment, in terms of enablers. What enablers are needed for a better way of working for real change? You know, Duncan has started to talk about some of the stuff that the sector is doing. So in your view, what enablers are needed for a better way of working together for real change, Jen, from a holistic policy advocacy perspective, not just clearly in the insurance sector?
Yeah, I mean, we talk about enablers and levers of change a lot at Climate-KIC, and recognize that it's multifaceted. And so sometimes that's also how we'd structure projects, where we actually work across working groups and across enablers like technology. It's why I have a bent around finance and investment. So it's a hard one to answer, because it is a case of understanding enablers and understanding where the best bang for buck is still, and recognizing that there's a suite of things that are needed, rather than there's no silver bullet here. That is one thing that so yes, it's good work, but the insurance create the incentives, and they have this price indication, and I completely agree, this long-term thinking is required, but it's also about the community and how people work together. So I'm looking at that finance as an enabler, and how we can actually make it an enabler, and how we then channel investment into all the different things, really good projects that need investment that often don't get it because they don't quite fit the square box of a business case. You know, things like that, where it costs too much to build a house, but if you look at the long term, it will cost a lot. So there's a lot of ways to do that. So yeah, there's a few. I guess I'm focused on some of those financial levers.
No one answer, no easy answer. We started by saying that you know, no one organisation, business or sector could solve climate change in a moment. So I would like to thank both Genevieve and Duncan for spending time with us this evening, for everyone who participated through questions and also listening and being part of the discussion, which is really important as well. So, I mean, I know we could keep talking through a lot of these different issues, and there's a lot of interest in the back of this, but just from us to our speakers and to our participants, a big thank you for being here with us.
Great. Thank you.
Thanks so much. And we'll stop the recording.